Intel just hit a 52-week high of $61.06, up 33% in a single week. The same week, the FTSE 100 closed down, Asian equities retreated across the board, and oil bounced back as the US-Iran ceasefire showed signs of fraying at the edges. The Nikkei fell 0.75%, the Kospi dropped 1.61%, and European stocks traded lower as Middle East tensions resurfaced. On the surface, it looked like a week where nothing held together. One market moved on geopolitics, another moved on something else entirely, and the gap between them is where the real story sits. The ceasefire announced by President Trump briefly sent oil crashing nearly 20%, and the S&P 500 surged through resistance at the 200-day moving average. Markets priced in relief. But by Thursday, that relief was already unraveling. Dan Coatsworth at AJL noted the agreement seems to be fraying at the edges, with Israel's ongoing operations against Iranian-backed positions keeping the Strait of Hormuz question alive. The FTSE 100 closed at 10,603, down just 5 points, but the FTSE 250 fell 1%, and UK domestics bore the brunt of uncertainty. Oil rose again. Petrol and diesel costs continued to climb. The ceasefire rally had lasted less than 48 hours.
While the macro headlines churned, something quieter was happening in semiconductors. Intel extended its weekly gain past 33% on the back of a Google AI infrastructure collaboration announcement. Marvell technology returned 26.6% over the past month, more than 33 times the S&P 500's 0.8% gain over the same period, and Barclays upgraded the stock, citing the AI infrastructure boom. Intel hit a 52-week high at $61.06, a level that sits $14 above the average analyst price target of $47. That gap is not a typo. The market is trading well ahead of where the Street's models currently sit. The common thread is data center infrastructure. Google's partnership with Intel signals a meaningful shift in AI chip sourcing. Intel's foundry ambitions suddenly have a credible anchor customer. For Marvell, the AI networking and custom silicon angle has been building since late last year, with its semiconductor industry peers gaining 10.6% over the past month while broad markets stalled. The Iran war dominated financial headlines for 39 days. It killed more than 5,000 people, displaced over 1 million civilians, and disrupted energy markets globally. Yet in that same period, a separate repricing quietly ran underneath. The market began moving capital toward companies building the physical infrastructure for AI, treating that trade as partially insulated from the geopolitical cycle. This is where the fund flow diverges from the narrative. The dominant story of 2026 has been oil, war, and inflation. The data beneath it shows institutional money rotating into AI infrastructure stocks, even as macro risk stayed elevated. Bailey Gifford's U.S. Growth Trust, listed on the FTSE 250, spent the first quarter picking through software stocks that had been hammered by fears that AI will eat software, and found that the software and services sector delivered its worst underperformance versus the S&P 500 in 30 years. That's the flip side: AI as infrastructure winner, software as collateral damage.
The durability question splits into two conditions. Intel's move holds if the Google collaboration produces actual volume, chip orders, not just a press release. The earnings call on April 23rd is the first hard test. Intel currently has no positive trailing EPS, negative $0.06, and its forward multiple is undefined. A single quarter of meaningful AI data center revenue would change the narrative structurally. If it doesn't appear, the 33% move is exposed as sentiment-driven and retracement risk is significant. Marvell's case is more grounded in execution. Earnings estimates have been revised upward, and the stock's 26.6% monthly return reflects a real change in analyst expectations, not just speculation. But the broader AI infrastructure trade depends on the rate environment staying cooperative. U.S. PCE inflation rose 0.4% in February and is expected to have climbed further in March as war-driven energy costs fed through. That trend keeps the Federal Reserve on hold. Higher for longer rates pressure growth multiples, and AI infrastructure stocks carry significant multiple risk when rates stay elevated. The weight of evidence leans toward the AI infrastructure trade having more structural legs than the ceasefire rally. Intel's Google deal and Marvell's data center positioning represent real demand, not just hope. But this only holds if Intel's April 23 earnings show data center revenue traction, and if PCE does not accelerate further in the March reading. If PCE comes in above 0.5% month over month, rate cut expectations compress further, and the multiple expansion that drove these gains becomes the first thing to unwind. Watch Intel's April 23 earnings call, specifically any quantitative guidance on AI chip orders. That is the number that either confirms the repricing or exposes it.